Hello, listeners. This is the very first episode of Bonds of the Stock, or BOSS as we call it. My name is Raj Singhal, and for those who don't have any context of me, I was last working as MD and CEO for Southeast Asia at Bank of America, where I worked for a couple of decades. I've been a macro trader all my life. Investing really excites me. I'm a big believer of the saying that millionaires are not made by making millions, but by saving millions. What's going to be our format? I will bring you up to speed on what's happening in the market, especially what happened in the week. Then there will be interview with one of the bonds in the market, as our title says. These are the people who have not only have had a very successful career, but also those who have had a very successful investing life as well. I want to give some little guidance on how to use the shows. We are here not to give any financial advice. We are not giving any stock tips. I actually don't believe that people listen to stock tapes, and I sincerely believe that people are better stock pickers only in hindsight. We are here to give you principles to be used for investing, and we believe that advice needs to be personalized based on one's situation. So please treat everything we discuss here as public opinion. What we want to accomplish from this podcast, we know that there are tons of podcasts to spoil you for choices. I've been a trader in my life. I've run a multi-million dollar business for one of the largest US banks. I've been an investor myself, managing my own money. But I had to learn the hard way. I had great mentors for my career, but never had one for managing my money. Or let me say, I never looked for one. So what we want to do is help you untangle the world of investing. We want you to develop skills so that you can manage your investments well, and then you will not need to work for money, but money will work for you. So without further ado, I would like to introduce through interview our guest. Is he a guest? Sandeep Baid, a very good friend of mine, ex-colleague, very successful career, expert in structured credits or credit in general. This is an experimental podcast with him, so that it makes us a low stress, no stakes experiment for our episode 1. So here, let me call Sandeep Baid. Hey Sandeep.
Hi Raj.
How are you doing, man?
I'm good. I'm looking forward to Rum with Raj.
Great. Why didn't you, I've given a brief introduction about yourself. Why didn't you tell our listeners about yourself?
Hey guys, so been working in financial services for the last 21 years now, seems like yesterday. By way of education, I am a graduate from IIM Calcutta, passed out in 1999. Have been investing career since then, both for the organizations I've worked for and as well as myself for my own small personal monies. So worked along with Raj at DSP Merrill Lynch, and post that co-founded an NBFC and raising private equity money, and built that business, and today it's listed, called Indostar Capital. And I will say that last 21 years have been fascinating because one keeps learning all the time. I think that's the beauty about investing, that markets keeps on changing and markets keep on teaching you something new. So looking forward to chatting with Raj, sharing some of my learnings, learning something from him as well.
Been a great run for you, Sandeep. So you brought in that you've been working for 21 years and investing. Did you invest very early in your life, or you've been only investing since you started working?
So unfortunately, my financial situation did not permit me to invest before I started working. But I started working in 1999, actually May 1999. And that, by the way, was a time when markets were doing very well. It was the late stage of the tech bubble. And I did invest some money in that and promptly lost that money. And which by the way, I thought was very good, because early on at the start of your investing career, if you will typically invest small because you don't have much money. And if you lose that money, you can earn a lot of lessons which stand you in good stead over a much longer time horizon.
Awesome. So maybe I think it's the right time for us to tell our listeners what's been your investment philosophy like. I mean, you've been doing this for some time now, and you've actually seen all kind of markets. I mean, the big boom in 2000s, then the burst, financial crisis, then boom, and then India has gone through many crises, especially in 2013, and then again now in COVID. So, how what's been your philosophy? Has it changed? Has the cycles taught you anything? Maybe you want to bring in some points here.
So market cycles always teach us something. I mean, every cycle is new, it's different. And that's why, in hindsight, people say, the markets were at bottom, the markets were at peak. Uh, and that's because there is something new in that cycle, right? Because if there was nothing new in that cycle, people would have identified that bubble or that bottom much earlier. Uh, in terms of principles of investing, I like to keep investing simple with 2, 3 core principles. One is there must be some diversification. You cannot put all your money into equity, all your money into debt. No, there needs to be a diversification. Second is the percentage allocation to each asset class should be a function of whether that asset class is cheap or expensive relative to its historical valuations. I personally look at algos which keep telling you whether that particular asset class is right now expensive or cheap. For example, not very long ago, in 2018, the small cap index was actually at 9,000, and the small cap price to book was actually at an all-time high. So basically, a simple charting was telling you that small caps are now at perhaps all-time expensive valuations. So you should be taking money out. Now, mind you, that's easier said than done, because at that moment you are making a lot of money in small caps. But I think it's important to try and have the discipline to say that, look, this asset class is now very well valued. Let me take some money off the table. So, in short, my investing philosophy is have a mix of asset classes, try to allocate money to those asset classes which are cheaper relative to historicals, and perhaps a little bit out of fashion as well.
Let me stick with the equity markets, and because I assume that a lot of our listeners would be interested in that. And when we look at the equity markets, I mean, the Indian markets, if you look at the last couple of years, uh, have not had the earning growth, even because of the variety of reasons. I mean, people can call it demonetization, then GST and whatever, and now COVID. But the markets always remain expensive. I mean, for example, your DMarts of the world and are trading at like 70, 80p. Uh, uh, I mean, people say that there are not too many quality stocks and they got to be traded at premium. Uh, what do you think on such stocks? I mean, the supposedly high growth, though they're actually not really high growth, but high premium now.
So that's a tough one, Raj, because uh, uh, obviously these are very high management quality companies. There's a shortage of uh, companies in India with very strong corporate governance, uh, established business models, and which are promising growth for, let's say, the next decade. And naturally, it becomes a case of a lot of money chasing these few stocks, which results in valuation multiples that are truly expensive, right? 70 times earnings. I mean, wow, that's expensive. So it's a tough one, Raj. I personally would shy away from such stuff because, when the equity market starts to discount too much of the future, that we are excluding the possibility that some events may happen in future that turn all our assumptions upside down, because nobody does know the future. To justify a multiple of 70 times, 80 times P, we do need any kind of Excel model will show that you need to achieve growth rates of 20, 25% over the next decade. And we don't know how the next decade will play out. So, I am not a very big fan of investing in stocks that are, at 80 times P, because there is no what, Benjamin Graham calls margin of safety. We have already factored in a lot of optimism, and if that optimism were to change for any kind of reason, fundamental, perceptional, the stocks could see a significant amount of downside. Having said that, will you short those stocks? No way, because you know, as I said, these are quality companies. They can keep performing. The markets can keep rewarding them. But I really don't have these ATP stocks in my portfolio.
Awesome. By the way, what do you think of the current market?
I think one thing the market is telling us is that it's forward-looking. Obviously, at the ground level, we are seeing a fair bit of disruption due to the COVID issues that have come up. But the market has taken this in its stride, locally as well as globally, and uh, you know, uh, is not that far from its highs. I don't look at how far it has run up from the March lows, because the March lows were also in part due to a liquidity crunch that was happening, because everybody was redeeming money from ETFs in the US at the same time, and a lot of ETFs had to sell simply to satisfy those redemptions. So I don't look at how much the index has risen from March. I look at what is the absolute valuation of the index vis-a-vis historicals. And if I look at that on a price to earning basis, the Nifty is, by the way, at an all-time high. On a price to book basis, it's probably just above median. It's okay. The small cap index is actually not that highly valued. It's today at a shade under 6,000. It was at 9,000 in March 2018. It doesn't appear that expensive. So even within the market, there are segments, but I think most important certainly is that the market is trying to look forward and say that the impact of COVID may not be beyond, let's say, a year or so, and the stock price is nothing, as we have learned, but a present value of a company's future cash flows, and all its future cash flows, not just the next 1 year cash flows. So I think what the stock markets are trying to say is that even if the next 1 year's cash flows are impacted, the impact on the present value of all the future years of cash flow, which by the way is nothing but price, should not be that high. Now, you could argue why the market was not saying this in March. Why did the market fall so much in March? There were two reasons. One is that the impact of COVID on the ground at that time was actually more and was suspected to be more than it eventually turned out to be. That time there were people in Europe and US who were dying. There were full lockdowns. Today the situation has improved a lot. And there was also a liquidity sucking up from the system with people withdrawing their ETFs. I think the market started rebounding once the Fed made that very important announcement on, I remember that date and time. It was Monday, March 23, 5:30 in the evening, India time. That was the day on which the markets fell 13%, which was the biggest loss in this 2020 bear market. On that day, the markets fell 13%. Nifty fell 13%. 5:30 in the evening, Fed came up with that announcement that they are going to support all these asset classes with liquidity, bond buying. They will even buy corporate bonds. They stopped short of saying they'll buy equity, but basically gave full commitment to supporting the markets. I think that was the turning point of the market. On 24th March, the Indian markets didn't rally much, but on 24th March, during the day when Indian markets were rallying, were not rallying too much, rather, you could see that QSIDs, which is the equivalent of liquid funds in the US, gold, all have started to rally in the US. 24th March evening, the indices also rallied, and on 25th March, the Indian market also rallied. So this is the impact of liquidity on the system. When liquidity was being sucked away, prices fell like dominoes. When liquidity came in, the market also started rising. And the billion-dollar question is right now, is this rise purely liquidity driven? Because liquidity can tend to be fickle, or is also fundamental driven. Now, if one knew all the answers, one would be, one would need to be a crystal ball gazer. One doesn't know all the answers, but what one would say is that probably markets are looking fairly valued. I do not think markets are inordinately expensive for two reasons. It does seem that it does look on the basis of the data that we have that the impact of COVID is not going to last for years and years. Yes, it could be very bad in the next few quarters, but it's not going to last for years. So there is no need to, really say that stock prices should be trading at very, very low levels because stock prices PV of all future cash flows. And when the markets have liquidity, they can take that view. If the markets don't have liquidity, they will not be able to take that view. But with the liquidity support that is coming, markets can say that, look, let us look through the next 4 quarters or 6 quarters. Anyway, the yields on the fixed income side are not much. So your opportunity cost is not much. So if you were to stay out of markets in the next 18 months, you would not make much on the fixed income side. So I will say the markets look fairly valued. If we get into a situation where the price to book multiple also starts to get into territory which is much more expensive to current, then yes, it might be time to take money off the table.
Actually, that's a great point you brought in because first of all, by the way, you remember even that time. That shows how top you are on the markets. So you brought in that price to earning and price to book, and probably in a year like this, when you know that the earnings are going to be impacted because of the situation, which is probably looks like will not last long, the whole pandemic. So then price to book actually becomes a good indicator as well to look at. So it's not just usually people look at only price to earning, but I guess if for serious investors, they need to look at multiple ways to look at things. Do you? You say that markets look fairly valued, not expensive. People, I guess, should remain. Should be involved in the market. Any particular stock you like? With a full disclaimer that this is not a, we're not giving any advice or tip here. But any stock you like, or you want to dwell on that?
Raj, let me. I no longer own the stock, but let me share that anecdote with you. I told you I passed out in 1999, and then in I think it was February 2000, there was an IPO of a company called Glenmark. So I put in money in that IPO, and I got shares worth allocation worth rupees 10,000 rupees. Now, in those days, the shares were allocated in a physical certificate form. So I had that form in my cupboard. I think maybe after 2-3 years, the company shares went into demat form. I was lazy. I never got those shares dematted, and they remained in my cupboard. So I finally got them dematted in end of 2006, and then I sold them, and I made a 40x on that. Now, no investing skills here, pure luck. Why I'm relating this anecdote is it shows you the power of compounding. That's part one of the story. Part two of the story is that from end of 2006, early 2007 to now, the stock price is where it was. So first 6-7 years, the stock generated a 40 to 45x return. The next 13 years, it generates a near zero return. So that kind of shows you that it's very important to diversify your portfolio because nobody can predict the future for sure. If you diversify your portfolio and have more than just a very, very select stocks, you are increasing the chances that the stocks which do very well will make up for the stocks that don't do that well. And that's why I feel all our listeners should have some allocations to index funds. They are a very cheap way to access a lot of stocks. Uh, Raj, I haven't answered your question on one stock that I specifically like. For the very simple reason that I do also change my mind, like most investors, right? So if I like something today and I don't like it 6 months from now, there's no way for me to be sure that 6 months later, Raj, you will be taking another podcast of mine and asking me which is my favorite stock, and absolutely no guarantee that some of our listeners today will be listening to that. So that's kind of some of the pitfalls of getting very, very individual stock specifics. So I'm sure you will excuse me for not answering a single stock, but rather relating an anecdote of one of the stocks that I used to own, made good money on it. I think all lady luck.
Luck is super important for sure, and looks like clearly you have lots of it. So keep it up, and I'm very clearly very sure that we're going to be having a podcast in next 6 months or 1 year. So be ready with that, and I will again ask you. I'll again try my luck and ask you a question at the time. Uh, so let's get ready for some rapid fires.
Okay.
Okay.
So I think when I said looking forward to Rum with Raj, I didn't realize the format is same as Coffee with Karan.
There's no coffee here though. There's no coffee, and there is no sofa to sit on, and also with someone. So anyway, let's move on. Uh, so who is your business idol?
So I will say no one idol, but there are a lot of people I admire. Somebody like a Warren Buffett, simply because of the absolute and the CAGR he has delivered over such a long period of time. That's not easy to do. Many of us can say we made great returns in this 3 months or 6 months, but to do it over 50 years plus, that's phenomenal. Another person I do admire a lot is Aziz Premji, because he is somebody who has publicly and legally given 75% of his wealth to philanthropy and non-profit causes. I mean, that's amazing, right? Because, at his level, there is a limit to how much he can spend on himself. And this thought of using that money for the greater good of the nation is simply brilliant. A lot of people in the Western world do it. In India, it is less so, but I think he is showing all of us of a path and acting as a role model. That number may change. It may not be 75 for all of us. We don't have that luxury. That number may be much, much lower. But I think he is teaching us that we do need to give back to society as well.
Awesome. I mean, I love Mr. Premji for what he's done or what he's doing. Who is your life idol?
Well, again, there is no one life idol, so simply because so many people around, so much to learn from each of them. So I will say, in my early days, one thing I learned a lot from my father was honesty, the value of honesty. Because, if one is honest and the other person believes in you, even if you make a mistake, he will give you a second chance. Uh, if you are honest, you don't need to remember what you said, because what you would have said would have been the truth. So your life is much simpler. You don't need to remember what you told who. And I think that's a great thing for me that I've learned from my father. Uh, uh, and otherwise, there are many, many, many idols, right? So, one admires Kapil Dev for his sporting spirit. Uh, One admires Virat Kohli for his fitness. Uh, there are many idols. I think it's important that we realize that all people have goods and bads, and we try to pick up the good and learn something from that.
Great. Uh, which book you read last about investing?
I am actually reading a book which is the called the Bible of Investing. It's that Benjamin Graham book. Reading it because our other friend and co-founder Meher has suggested it, and I must say I'm liking it a lot because the concepts are very simple. It's about investing when there is a margin of safety, staying away from herd mentality, uh, and I think very, very nice and brilliant concepts. Now, obviously, that book was written many years ago in a different context, and one has to read it with that lens that today interest rates are near zero. And in those times, interest rates, the US government securities interest rates were more than 10% in 1980. So that changes how the market multiples will be in a big way. But I think an intelligent reader of the book, The Intelligent Investor, will divide that book into what is permanent good advice and some things that need to change with the market, because obviously no book can be 100% relevant 100 years into the future, especially in financial services, which changes so fast. But it's a great book. I wish a lot of our listeners read it. Obviously, they need to apply their discretion and filter out certain things which are no longer true of our times. But many of the basic advice is very, very true.
Oh, great, and I would also agree with you that this is one book which everyone should read. What we can do is we'll put up the link to the book in our notes in our podcast, so that people know which book we are talking about, and if they want, they can buy that. Uh, with whom will you? I mean, you're talking about Benjamin Graham, and you've spoken about Warren Buffett as well, and Buffett was a follower of Graham. With whom you will identify your investing style with?
So
or you have your own, so we all can follow your style?
No, I will say that obviously no comparison of the measure of success at all. I mean, these gentlemen are in a completely different league. But yes, I would identify my style with them because some of the basic principles are same. Stay a little bit away from herd mentality. Uh, uh, Try to invest in asset classes that are cheaper, so that you have more margin of safety. So yes, I think some of the basic tenets would remain similar.
Okay. What would be your one best and one worst investment so far?
So I think in the year 1999, uh, I invested in a tech company, uh, which in 2 years was about 1 or 2% of the value that I invested in. So you can call it actually my best as well as worst investment. Worst because the return was minus 98%. Best because it taught me a lot of lessons, right? At the start of your career, a little bit of money you lose. Uh, I think that lesson is worth a lot. So I'll just put, I don't want to name the stock, it no longer exists, but, and neither would anyone care for that name because it just isn't there. But it was one of those tech bubble fueled stocks, which is my best as well as worst investment.
I mean, the story sounds very similar because I also have one such stock, and I can keep seeing that one name in my demat portfolio every time when I see that. So it looks like the company still exists. uh, uh, where do you see yourself in 10 years? I mean,
Don't know, yeah. Life is actually a journey. So far it's been good. Let's hope that the journey continues to be good. I will say, if I can do a variety of stuff, which includes, learning more about market, sharing some of my knowledge about markets with others while learning from them. It's a two-way process. Doing something more on the non-profit side. I think if I can achieve these 3-4 aspects, that should be pretty decent.
awesome. What advice will you give to your 20 self?
I think the most precious thing is time. Uh, People think it's money, people think it's something else, but just given the human span of life, the single most precious thing is life. In life is time. and have fun with it.
I agree, and I mean, I read again a good line that when you are young, because you think that you have a lot of time, you actually waste a lot of time, which you realize only later part of the life that you actually didn't have that much time. Uh, no, I think awesome, Sandeep. Thank you so much. I'm sure been very it's been great, helpful, useful advices from you. You've been in the market for long. You're a constant learner, so thank you so much for imparting those jewels to our listeners.
Thank you so much, Raj, for giving this opportunity. It was wonderful to chat with you.
Thank you.